Good morning, everyone, and welcome to M&A in Today's Economy and the Deals Go On. I'm Jennifer DeCamp, and I'm the Director of Client Services at SB LiftOff. SB LiftOff is an M&A firm serving the mid-market, including a real focus in GovCon. So I'd first like to take a moment to introduce you to our panel today. Our first speaker is Sharon Heaton, CEO of SB LiftOff. Sharon has advised on transactions totaling more than $12 billion in deal value. She founded SB LiftOff to bring high-quality M&A advisory to the mid-market, and this female-led investment bank based in Northern Virginia is growing nationally. Sharon got her law degree from the University of Chicago Law School, a BA from Barnard College at Columbia University, and has been associated with the law firms of Skadden Arps and Lathan and Watkins. Joining Sharon today on the panel is George Nemphos. George is a founding member at Nemphos Braue, one of the leading corporate and business law firms specializing in mergers and acquisitions, startup and entrepreneurial law, intellectual property, and technology transactions and procurement. George has extensive experience in representing and assisting clients in entity choice formation, mergers and acquisitions, private placements of debt and equity, complex joint ventures, structural and day-to-day issues, as well as corporate governance and securities law compliance. A link to full speaker bios as well as contact information can be found in the reminder email you received this morning. So I'd like to quickly go over our webinar format today. During our panel discussion, we will be launching polls so that our speakers can customize the discussion based on your responses to those polls. You can also submit questions through the entire webinar, and our speakers will start answering those questions approximately halfway through the webinar. Please submit your questions through the Q&A option located at the bottom of your screen, as the chat option will be disabled so that we can keep all questions in one space. So let's get started. Sharon, why don't you kick us off by filling us in on M&A in today's economy?
Absolutely. Thank you very much, Jennifer. George, delighted to be here with you today, and I want to thank everybody for attending the webinar. I want to start off by talking at the macro level a little bit about the economy, and then talk a little bit about how M&A fits into that. So let's talk about the economy. And I have to start off with a shoulder shrug and say a little bit of, I don't know. I'm looking at the Dow today being up over 300 points because of very promising results about a vaccine and Goldman Sachs trading successes. That's terrific. On the other hand, I'm reading about historic levels of deaths and an unbelievable rise in the number of coronavirus cases that are happening kind of on a daily basis. When this first happened in March, what happened is what you'd expect: the stock market collapsed. Now the stock market has regained all of that ground and seems to be doing pretty darn well. Nonetheless, we're still looking at very high levels of unemployment and a tremendous amount of uncertainty. So to me, the one word that seems to really encapsulate the economy at this moment is uncertainty. Which of the various factors are going to become the driving force behind the economy? I've heard all sorts of alphabet letter discussions as to whether it will be a V-shaped recovery or a U-shaped or a W or an L. And it's like, the reality is we can speculate till the cows come home, and we really just don't know. So the question means, in that level of uncertainty, what does that mean for M&A? And it's been very interesting. The market has clearly changed over the last 6 months. But it's not necessarily changed the way you would have thought. In 2008, when there was a very serious economic collapse, M&A really dried up. We're not seeing that at this time. In March, I actually, SB LiftOff was able to close a deal on March 20th. So several days after everything closed down, we closed a over $25 million deal. We also signed a letter of intent for a transaction. Now, both of those were in the GovCon space, and GovCon has been a little bit more protected than the commercial market. Having said that, to say that there's any kind of blanket way of looking at the commercial market seems wrong. If you're in restaurants or nails or in a retail business, then yes, the coronavirus has been devastatingly terrible. But if you are, let's say, Zoom, then the coronavirus has basically pushed your business plan forward by 60 years or 6 years. So it really depends upon where you are in the market. And that's where I'm coming down for M&A. It's a case-specific situation. Many players who were buyers in the market in January and February are not there now. But there was a historic level of dry powder, of money that had to be allocated to the purchase of companies by PE firms, search firms, et cetera, and they still have an obligation to deploy that capital. So they're looking for good opportunities. On the sell side, I think you need to kind of look hard at your company and see what level of impact the virus has had. If the virus has had an impact that's been more than, let's say, 10 or 15% of your revenue, then you need to look hard as to whether or not it makes sense to go forward in this market. But we have a lot of clients and people that we're talking to that are in fact doing extraordinarily well, and the virus has had no impact on their business. For those companies, this is an extremely attractive time to go to market because a lot of the wheat has been separated from the chaff. And if you can be one of those companies that is highly desirable and there's a limited universe of those available, I think this could be an extremely good time to go to market. So I think it's very much a case-by-case situation, but it is clearly not true that the M&A markets are closed. They are not. And when we say that, we also have to be focused on the fact that M&A markets are different at different levels of size of companies. When you've heard, and I'm sure we all have, that M&As tend to lead to a decrease in shareholder value, that's true when you're talking about very large deals. But if you're talking about deals in the enterprise range of, let's say, 10 million to 100 million, those companies generally lead to increased value for shareholders after a year or so after the transaction. And there's all sorts of reasons why, and we can talk about that in greater detail. But the idea that the M&A markets is closed is wrong. You need to be very specific about what it is you're trying to achieve. You need to be careful about who you're doing business with, but there are absolutely deals going forward and going forward without price adjustments. George, what has been your thoughts or experience in this economy?
No, thanks, Sharon. And again, thank you everybody for attending today. And Jennifer, thanks for the nice introduction. Sharon, I have to absolutely agree with it, with what you're saying. You know, we also have had several deals that were actually in negotiation prior to the COVID shutdown. And what we found is that while we were in fourth gear, we downshifted into second gear, if you will, and they continued going forward. We have found that the process is taking longer, as you would expect, because let's face it, every day we're hearing a new travel advisory. If you go to New York, don't ever leave. If you're coming from Texas, quarantine for 30 days and don't go near anybody for a year. It's gotten very suffocating in some ways in the social settings. But what's been interesting is, as suffocating as it's been in a social setting, in the M&A market, it hasn't snuffed it out. It has made it potentially a little more complex at times, not because deal concepts have changed, but it's because we're not able to get the face-to-face meetings. They're not able to do the in-person management meetings, visit the facilities, touch, feel, taste, which frankly, even in our high-tech age, we as human beings and as buyers and sellers still want to touch, feel, and taste. Gosh, that's why we have supermarkets still. But what we have seen is still this underpinned drive to get deals accomplished, and that the flexibility factor has now had to increase in how to go about getting that deal closed. I'm picking up on something you said about it's a case-by-case basis. It's industry specific. There are industries right now that are extraordinarily hot and will stay hot. Government contracting, government-related businesses are still very much in vogue and still doing very well. Government still needs to issue RFPs, and business and work still needs to get done for the business of governing and everything that goes along with it. We're also seeing industries that are in the food supply chain continuing to grow and expand. Industrial services continuing to grow and expand. Healthcare. Healthcare is obviously going off the rails right now. Everything from insurance-related products to, quite candidly, telemedicine. You mentioned Zoom. The same effect is occurring in the healthcare telemedicine space. People who said they would never visit their doctor on their iPhone or their Google phone or on their computer are now having those appointments with their doctor and realizing that it's a smooth technology. It's easier. They don't have to sit in a waiting room, fill out forms, tap their foot, as somebody who just got there, got ushered in before them. So it has become an interesting time in the M&A space. Where there are good deals, there will always be deals. Where there are industries that are fulfilling current needs, there will be deals. The things that we're finding are more of an attention to detail in certain areas of the due diligence than we would have seen in the past. And everybody talks about the retrade. Let's get this deal signed and get done because I don't want to be retraded. I don't want something to pop up in the purchase price. Well, what's interesting is that sellers are having to take a step back right now and realize buyers are going to look at the situation almost daily. A great example is we're currently in the middle of an M&A transaction right now. We are actually representing the buyer. It's a very sophisticated, long-time buyer in an industrial space. And we are keeping a close eye on their contracts. 2 days ago, what do you think happened? Number 19 on their list of 50 customers just had to shut down 2 of their facilities because of COVID. Contract on hold. Hits the revenue, hitting EBITDA, and a whole bunch of other areas. So I'm expecting there to be a discussion and having to be some flexibility in the manner in which potentially this purchase price is paid. So the good news, I agree with you, is M&A is still going and it's somewhat robust in certain areas, in certain industries. The deal terms are becoming more case by case, we're finding, and that what is market, which is a favorite word that lawyers like to use in negotiations, is becoming more and more fluid, and it's potentially being made up as we go along. So, it is an exciting time if you are in an industry that is booming or at least was minimally affected by COVID. It is a difficult time if you're in an industry that is still feeling the flux and trying to deal with where things are. And, a deeper dive and a deeper analysis probably needs to be had as to whether or not to sell or buy right now.
George, let me follow up on something you just said because I think it's really important. Obviously, in the current environment, healthcare is very important, and so you'd figure that healthcare would be doing very well. Well, it depends upon what segment of healthcare. If you're in healthcare IT, yes, this is a great time, and there's been really no impact. If you're a medical practice of some sort, it actually begins to depend upon what kind of insurance. Who is your payer? Because as you mentioned, telehealth is becoming a very big deal. And we're finding that we can actually treat a large number of issues through telehealth. But there are some insurance companies that will only provide a fraction of the payment to the provider if it's a telehealth visit than if it's an in-person visit. So there's all sorts of chaos in this market, depending upon whether or not you're getting full compensation for your time on a telehealth as if you were seeing an in-person. So that's the level of due diligence I think that's going to be required going forward, at least during this time of uncertainty, that maybe 6 months ago you would not have thought about. It's what is the percentage of people you're seeing in person versus telehealth, and how do the insurance companies treat those telehealth visits? A question that probably would not have been on my due diligence list 8 months ago, but is very much on my list today. George, what do you think?
I completely agree. And what's interesting is I think in some ways we have a client right now working through some issues. We're actually seeing that very issue is driving a deal point in something that they're negotiating, and we all hate earnouts. Every client hears, "Oh, I'm going to get an earnout." Lawyers and investment bankers all kind of, cross our fingers, roll our eyes, and go, but those are the situations, you hit it on the head, that are actually driving some sort of metric for future performance and potentially future compensation, or in the event that someone's taking on an investment, a valuation adjustment. Layer over top of that, and your point is well taken, layer over top of that, if it's Medicare or Medicaid, which is a system that is completely in disarray right now. And, there's really no main fix for it anytime soon. There's patches, and then you've got state level patches, and you've got, it's just craziness. But you're right. We're seeing that even though that's an issue in that space, there's a real push to get into it and buy it and acquire it or be a part of it and bank on the fact that there will be something that gets fixed down the road, which is interesting. Your point actually leads also to who's going to take the risk. It's strategic investors and strategic buyers more than financial buyers. We have seen, for example, the big pharma companies now trying to figure out how telemedicine fits in with, drug development, deployment, and prescriptions, and trying to match up some aspect of telemedicine with their drug delivery in order to garner more prescriptions being written, as well as as well as getting it on more formularies. For those that may not know, insurance companies create formularies. So if you go in and you're supposed to get some sort of statin for your cholesterol, and your doctor writes you a script for X, and then suddenly you get a phone call from your pharmacist that says, well, X is not on your formulary, Y is, it's the same thing, you okay? And so suddenly you're buying Y, not X, because that's what they want. So part of the goal in that situation, in responding to the telemedicine questions and the fact that, insurance companies don't know quite what to do with them yet, and paying for them, the pharmaceutical companies are now out looking to buy or significantly invest in telemedicine companies that they can tie to their drugs for prescriptions to get it on formularies. So therefore it's paid for in another avenue. So the complexity that's been caused by the coronavirus and the responsiveness that industries have been having to it is also driving significant revenue opportunities across a variety of industries that are willing to be flexible. And those are the same industries that it appears for now that M&A is still really moving forward and potentially getting more aggressive.
George, let me say something that might be controversial, but I actually do believe, which I'm going to give a defense of earnouts. Now, I know that every seller in the world wants to get all their money at closing. But let's start with some reality stuff here. The seller is always going to know more than the buyer will about the company. And the buyer is putting down millions of dollars, and they are nervous. What does the seller know that the buyer doesn't know? And part of the concern is the seller looking to drop their keys off on the table, walk up into the sunset, and never hear about the company again? And if they do, a buyer is going to say, yeah, why is that? I'm not so sure that I want to be buying a company that a seller wants that for. So first of all, there's a confidence building element, whether it be a promissory note or a rollover of equity or an earnout. But second, on the earnout specifically, the buyer and the seller need to come to an agreement as to what the company is worth today. And the even a multiple and all the rest takes into account some of those changes for what is there today. But very often, sellers have what I refer to as planted seeds. They have things that haven't yet flourished, but they've planted the seeds for those, and they turn to the buyer and say, I planted all these seeds, I've watered this, I want to have the value of that. And the buyer is saying, but it's not there right now, it's just a bit of dirt. An earnout is a way to share the risk between the buyer and the seller as to whether or not those seeds are going to turn into something beautiful or whether or not it's not going to happen at all. It is perfectly rational, and the buyer should pay for everything that they're getting today. But for things that are contingent or possibilities, it is reasonable to ask a buyer and a seller to share that risk. Now, it has to be structured well. I personally believe that earnouts should never be based upon net income or EBITDA or things like that, because it's too easy for manipulation. But an earnout that is based solely upon a revenue stream from those seeds that have not yet sprouted, that kind of makes sense to me. And that might be one of the areas where I think sellers are going to need to be a little bit more flexible. I think that sellers need to be concerned about whether or not the buyer has the capital to get to closing. That's a big deal. But I also think that the seller needs to be a little bit more flexible on the issues that are contingent, because the world is changing so rapidly. You know, if you told me 2 years ago that last year there was going to be a 35-day government shutdown, I would laugh at you. If government shuts down, maybe it's 3 days, 5 days, 8 days, but not 35. And if you told me 6 or 7 months ago that there was going to be a global pandemic that was going to cause the economy to shut down, I would have laughed as well. The reality is that, you know, what's the phrase that, you know, man plans and God laughs? We can only see what we can see. And I think that earnouts will become more significant for the contingent parts of these transactions going forward, because we have a greater understanding of the uncertainty of what might be occurring over the next year or two. George, what do you think about that?
It's a lot to unpack. You know, you know, it's funny. Look, I don't disagree. I mean, earnouts are great bridges. I mean, they were very popular in the early 2000s. It was a way to get in, get the deal done, get everybody on board, get momentum, and make something actually happen. I think today you hear, you know, most entrepreneurs will say to another entrepreneur, "Oh, you signed an earnout? Good luck."
Exactly.
And, yeah, I mean, but you're right. You know, especially in times of uncertainty in which a lot of seeds have been planted, there's a decision that an entrepreneur has to make. A seller has to make a decision. Do I move forward in these times with selling the company or not? And if you move forward in selling the company, you are likely to have to do something to help bridge the gap and get things through. Because you did raise a few things just now that are becoming more difficult. Capital access. Banks, they're a bit of a disaster right now in the lending space when it comes to deals, because they're not quite sure what to do. We are seeing a lot of seller takebacks, financing, seller rollovers in financial deals. Earnouts, yeah, we're seeing them. You know, you do raise the good point of nobody likes to see it on net income. No one likes to see it on EBITDA. Buyers want it on that because that's generally what they're buying against with a multiple. And so they want it. So then, you know, my job as a counsel can become a lot more difficult and more annoying to everybody, to be candid with you, because then I'm sitting there going, well, let's figure out how EBITDA was calculated for the base purchase price. And then we've got to put up the bumper rails. And if anybody does duck pin bowling, they'll know when you hit the button for your kids, the rails come up in the gutter to keep everybody from throwing a gutter ball. And, you know, and what that boils down to is really tying down, well, what are all the margins? What goes into overhead? What goes into G&A? What is your expenses? What are the baseline clientele? There's a lot of pieces that can go into an earnout that you have to, as a seller and a buyer, be willing to dig into to ensure some fluidness and some stability post-closing. Because what you don't want to have happen, which quite frequently could occur in an earnout, as you know, is all you're doing is kicking the can down for litigation. And because someone's going to get ticked and someone's going to say something, and if the seller isn't staying on for a period of time to help with the transition, you got this push-pull. I think the bigger part of what you were really referring to, if I may, is that right now in the marketplace, there is going to be a gap in most deals between what the buyer is willing to pay and what the seller really believes they should be selling for. And usually it's because the seller has not, unfortunately, taken into account the past 5 months, right? In their mind, we're pulling through the past 5 months. I took care of it. I survived. I'm moving forward. And you're buying the upside because this is going to go away in time. And I'm going to be where I should, I'm going to be better than when I was before because I'll be one of the last ones standing. I will have grown my business or positioned myself to grow this business when everything's done. The buyer's coming in saying the valuations 5 months ago are not the valuations today. Yeah, there's upside here, but it's going to be my money that has to be put in to help develop and prepare the company for that upside. So I think really what you're really making a great reference to is that gap, that creativity, flexibility is going to be more and more important, probably to the end of the year, if not longer, in a lot of industries where people are still looking to sell and people are still looking to buy. Doesn't mean you can't get there. Doesn't mean that, it won't be a successful transaction for all, but it will require some flexibility. And candidly, groups like yours are going to be really important in negotiating that gap. Really
thank you, George. I appreciate that. And let me jump in there because I was going to say something just like that. How an earnout is structured and what you're thinking about that earnout really matters. The way in which I like to think about earnouts is that the amount of money on the table at close should be what the company is worth today. Sellers want more because they have built potential into that company, and a buyer is saying, I'm not sure I want to do that. So it's not that, you had an earnout possibility of $10 million and you got 7 of it, you lost $3 million. The reality is you got $7 million that you otherwise might not have gotten it at all. So it's a question of whether or not you look from the top down or whether or not you look from what the company is at close to what actually happens. A buyer, I think, would reasonably say, you tell me all these wonderful things are going to happen, I'll pay you if they do happen. But if they don't, how is it fair for me to have paid for those things? And that it becomes an almost existential debate for which there's no truth that you can ultimately come to. It's just the passage of time. So I agree with you that I think that sellers are not necessarily taking the last 5 months into account. Having said that, I'll also say that I do not see in some industries that there's been an adjustment to the EBITDA multiple, that the EBITDA multiple is pretty much the same, particularly in the GovCon market, where EBITDA multiples didn't get to the level of extremes that they did on the commercial market. So where on the commercial market, over the last 3 years, we were seeing EBITDA multiples on relatively small companies that could easily be in the 9, 10, 11, 12, 13 range, historically astounding numbers. I think those companies are going to be seeing significantly lower multiples. In the GovCon space, multiples pretty much range between 4 and 7, give or take. If you've got an extraordinary company, it might be an 8. If you've got a janitorial company, it might be a 3. I have not seen GovCon multiples materially change, but in the commercial market, I think that they're much more volatile. They were more volatile up, and I think they're going to be more volatile down as well.
I agree with you. I think GovCon is one of those industries that's, I don't want to say protected. That's not the right word. I think it's
insulated.
It's insulated. It is insulated. But I'll say this. I think we are, from what we've been seeing, I think you're spot on in the commercial markets. I think it's kind of getting around industry by industry. What we've started to see, and we've got a good example because we were a buyer. We were a financial buyer. We were representing a financial buyer in an auction process, which we knew that we were one of 3 at the end, and we knew the other 2 were strategics. Interestingly enough, what we're starting to see is the strategics who were out buying or trying to fill in holes have started to back off for a while.
Interesting.
So they're starting to back off. So as they back off, the leverage that they were going, that people were building into the deal and the cost savings and all the adjustments and all the little things they could do were going bye-bye. and these sellers still wanted to sell. So now it was more of the financial buyers out there. And what we're starting to see is the financial buyers, which were willing to come up to that strategic buyer multiple or get close and try to do the dance and sing to the seller to say, we're a better buyer because take some rollover or do this and that, you're going to be a part of our partner. We're seeing them, instead of pushing up to that multiple, they're seeing these guys go away, and they're starting to bring those multiples down.
Very interesting. See, now we're seeing something similar to that, but again, it's very case specific. Clearly, buyers would prefer to buy things less expensively. They're entitled to that. That's the way the world works. If they're finding a really strong company that has, on the GovCon side, let's say it's got a huge amount of backlog,
Sure.
Or on the commercial side, it's got a tremendous amount of recurring revenue without customer concentration. If you find those kind of unicorns that are out there, there's a lot of money that's looking to buy those companies, and those multiples are doing really well. Yeah. If you're seeing some hair in the deal, if you're seeing customer concentration, or if you're GovCon and your contracts are coming due in the next year or two, then I think that there's less tolerance for that in the past, now than there has been in the past. Jennifer, I think that we've been doing some polling. Can you give us the results of what that's been?
Yeah, I'd like to kind of share the results of poll 5 and 6, which was our last one. I think this is kind of interesting information. And I'll just share one because it's pretty similar for both. You can kind of get an idea there. Can you see that?
Interesting. It looks to me like what it's saying is, are you more or less likely to sell your company? I'm assuming there was a question about buying your company.
Yep.
And what I'm seeing here is either it doesn't affect my decision, or it's almost exactly equal between more likely and less likely. So, when those things balance off, you're kind of at status quo.
Right. And that was the same for the buy side as well. Very similar.
Very interesting, which comports with our experience. Now, George, you mentioned something in your initial comments that I wanted to go back to, which is that M&A is kind of the last lost art of finance. And people say that because it involves people. It's not so much as doing a discounted cash flow, which is, you threw it on an Excel spreadsheet and you're done. This is the seller saying, do I trust this buyer that I'm going to give them all this information and they're going to close? The buyer saying, do I trust this seller that they're being transparent with me so I understand the strengths and weaknesses of this company? A lot of that has happened over time in the past over meals. There's something about breaking bread with somebody that you feel a little bit more connected to them, a level of intimacy gets created. Management meetings have always been kind of a staple. Now we're doing management meetings by Zoom. There really is no breaking bread together for the most part. Since March, I've literally done one in-person meeting, and that was because the financing source for the buyer insisted on meeting in person with the seller. So we did that in a socially distant, appropriate way, and that was kind of an interesting experience. It worked extremely well. But there's obviously going to be a lot less in-person contact. One of the things that's been interesting to me, and George, I'll be interested in your experience on this, is that I'm seeing buyers and sellers willing to go forward with deals and in fact close deals with people that they've actually not been in the same room together, but feel like they've been on so many Zoom calls that they really have a sense as to who these people are. What's been your experience, George?
Probably like yours, a bit mixed. We are absolutely seeing management presentations Zoom. It's actually a great technology. People have woken up to that. It does make a management e-meeting very more fluid in some ways. You can have more people coming in and out of the management meeting for parts of it to make it more accessible. So we are seeing a move to Zoom, which you would expect, or Teams or whatever.
Or whatever the other ones are. Yeah, some type of video conferencing.
But what we are seeing is more of it. Like, what I mean by that, like, you have a couple visits, couple face-to-face conference calls, things like that in the old way. Now, everything's Zoom. The inability to get the physical and spatial connection, I think, has driven a lot of this to, well, if I've got to be on a conference call anyway, I'm at my desk, might as well see their face. Boom, Zoom. So there's a lot more, I think, connectivity in a deal through video and visual interaction than there used to be. Okay. And I do believe that that's somewhat taking the place of the ability to be hand in hand, because you hit it the best. We are a society that believes in, no matter what, it's breaking bread. It's getting to get a feel for your, who this person is that's selling you their baby. Is the baby as good looking as they said it is? It really is. So we're seeing a more of an effort to have connection via video. So that way, over time, there's this feeling that it's built up to what they would have thought they would have gotten by face-to-face. The other,
I have an etiquette question for you. I've done Zoom calls where a disproportionate number of people keep their camera off. And I've struggled with, is it fair to turn to somebody and say, would you turn your camera on?
Absolutely.
I'd like to see you. Or, and so I've actually, for management meetings, I've put in the invitation, we'd like people to have their cameras on so that people could shave or do their hair or whatever it is that they're not doing. But yeah, I'm surprised how many people are doing video calls but not turning on their camera and saying, and whether or not it's appropriate for me to say, hey, listen, please turn on your camera.
So it's interesting because we have seen in some of our deals where there's a line that says, no need to do your hair or change out of your pajamas. We don't care. We will see. We will see you. And it's in all caps. We will see you on the Zoom meeting. They don't even call it a call. They make it Zoom meeting. So everybody's on. I have been on calls on deals where someone doesn't have the camera on, and I've had a client say, look, hey, put your camera on, other than the fact if you're in some place that I don't want to know where you are. So it is, I do believe, is part of our society and our ability to say, please do this, please do that, expectations. I think what you're addressing and alluding to will be also part of the norm, like, hey, please have your camera on, or it will be, certain situations, it will be expected. My team has gone so far where we've got a deal that we're currently in right now, which was in fourth gear before COVID, shifted down to first gear, and now I'm being told, grind the gears, get it up, get it back up. There was a facility, a manufacturing facility, and they couldn't get on site. It was shut down. They were in a state which basically was under an order, essential business. So the owner took his iPad, literally duct taped it to his chest, hit the camera, and walked around the facility for an hour for the buyer and his team to see things at the facility, to know it was real. And while he was there, talked about everything. And it was funny because that same deal, when COVID, the stay-in-place orders were lifted and things started opening up, they were so desperate to meet each other, partially because Zoom was still like, kind of moment. They were so desperate to see face-to-face because there was a significant rollover. The seller's son was actually taking over the business and being a key member of the conglomerate's management team. They wanted desperately. Sharon, they met in a park. They went out, sent people out to this park, dragged 2 picnic tables across 10 feet from each other, put them under different trees, and they sat at the picnic tables at a distance from each other and just talked rather loudly, but talked and felt like they connected. And they had sandwiches that they were each sitting at their separate table eating. When it was over, they were done, they left. The rest of the time, everything was a Zoom call. And it was as if they were old friends. So what I took away from that is buyers and sellers will always find a way to get comfortable and connect. The technology we have will continue to assist us in those connections and overcome the humps that we deal with. You know, you, me, our colleagues, our roles going forward will be what they've always been, but where we always used to joke around like, God, I'm a psychologist today, right? In every deal, you have that comment. I think we'll actually be not psychologists, sociologists on helping them feel connected and helping them.
That's very important because, you know, I'm going to take a step back and say, what does an M&A advisor do? What does a lawyer do? And there is a counseling element to what we do. Because people who have built successful companies often have not bought or sold companies before. They've spent their time building that operating company, and they rely upon other people to help guide them through this process. And there's a humanity to it, because while it was funny, I was giving a speech at one point, and a banker in his 60s or 70s basically said, let's be honest, M&A is just a financial transaction. And I couldn't help myself. I laughed. And I said, no, because for the seller, it's kind of a report card. That company could be like a child to them. They've been raising it as long as they've been raising their children. They have a way of thinking about that company, and somebody is coming else and judging it. And so it's a very emotional process. Oh. And they also are very concerned about confidentiality and all the rest of that. There's a humanity involved. And what I'm kind of amused by is how the technology, rather than separating us, using technology to separate us as people, it's actually bridging us together. I mean, there's the famous story of when the Supreme Court started doing oral arguments by Zoom, and we don't know who it was, but somebody flushed a toilet. And it was, okay, now that's a historic first. But there is a humanity to that we all have to kind of appreciate. And when we're preparing our clients for Zoom meetings, whether they're the management meeting or the buyer side, this is a date. You've got to be prepared to present yourself in the most favorable way possible. How do you want these people to see you? And over time, who you really are will come out. And hopefully that's a good thing. But transparency is the most important. And we need to recognize that technology allows us to do that. I also wanted to follow up with something else that you said, and then open it up to see if we've got any questions, which is timing. It used to be that I could get to a letter of intent and kind of say 45 days to close. If I was giving them a lot of time, it would be 90 days. Sellers need to be more patient now. It will take buyers a little bit longer to put together their financing. There will be struggles along the way in due diligence that we're not used to. There will be third parties involved, whether it's a quality of earnings, lawyers, accountants, whatever, and they might be having a problem with a parent who is ill, or maybe they themselves are. So I think that the timing on deals from letter of intent to closing is more likely to go to that 120 days, give or take a little bit, and less from that 60 to 90 day period. And I think that we should prepare our clients for that kind of issue. George, has that been your experience?
No, it is absolutely our experience, and we're experiencing that. And I think something you said is really key, that any buyer or seller has got to get in their head. We're all people. It's a tough time out there right now. Some tougher than for others, right? I think, everybody's in some way, shape, or form, some aspect of their business is struggling to get through a piece. And it could, and then you add into it, you hit it on the head. This is my baby. This baby is the most beautiful baby.
It's a beautiful baby.
Yeah, it's beautiful. Beautiful. The closet is locked and maybe filled with dead bodies, but this baby's beautiful. You have that emotional sense. So it's potentially an emotionally charged situation. And for a variety of reasons. You then put the stresses on top of that of dealing with human beings, trying to get a job done in order to make a transaction occur, who are all dealing with ancillary stresses created by what we're going through. I'm back to my favorite word, flexibility.
Absolutely.
We are seeing it push 120 days. freaks out the sellers a lot because that's an extra 30 to 45 days in which something could happen and there could be a discovery. There's nothing you can do. You know, if you push it harder, you push people away. So in this scenario, we've been advising clients and working with clients on either side of the transaction, depending upon where we are. Just breathe. Remember, everybody's, trying to get this thing done the same way. The same way being getting all the boxes checked they used to do before COVID. They need those boxes checked now after COVID still. But unfortunately, due to what's happening, it just takes longer. And it could be nothing other than Sally or Joe, who are doing the Q of E, are dealing with the fact that Bob in the office has somebody who's sick and is out, and they've got to deal with something for them. I mean, it's just going to take time. So patience, flexibility, perseverance, and scotch.
Jennifer, are there any questions from the audience?
We do have a few from the audience. So we have one from Reza. Do you see M&A and consolidation movement in higher education, healthcare, and nonprofits? One just happened a few days ago in Delaware, and there are potentials in Maryland and other states, especially in the rural areas.
Very interesting. As an M&A person, I don't work in the not-for-profit market, although I think that there are people who do. It does strike me that smaller organizations have a infrastructure that's needed to support that organization, and you can probably reduce costs by having an infrastructure that supports a bigger organization. So I think that kind of consolidation is part of the reasons why there's M&A in the first place, and that in a time of restrained revenue or donations, it would make sense for there to be some level of consolidation. I'm certainly seeing that in the healthcare sector, and I think George is as well. I don't know about the nonprofits. What was the third area there?
Pull it back up again. Higher education, healthcare, and nonprofits.
Higher education is a conversation I'd love to have. I think it's going to undergo massive change. Yeah. I mean, if you're paying $70,000 tuition for your kid to sit home and to take college online, I think that they've got a business model problem here. But I think that's a little outside the scope of this conversation. George, what are your views?
I would agree with it on the higher education front. I think the business model is broken. I think it's been shown that it's broken. There was a big flux in the late 90s into the mid 2000s of online learning for high schools and middle schools and elementary schools. And I worked in that space quite a bit. There were several private equity funds that were dedicated to doing that. Probably a little ahead of their time, but they had the right idea. And we're seeing things that were coming out of that being pulled up and in. I think higher education is headed for, and I will call it an industry-changing event, tidal wave, tsunami. People are discovering that online education can work if it's done properly and done with conviction. So I like you, that's a whole different subject that you could have a million experts on. Nonprofit, we do some work with nonprofits and dealing with spin-offs and potentially some acquisitions internally in a variety of areas. The nonprofit world is struggling. They're feeling the pinch desperately. Corporate sponsorships have dropped exponentially. Donations have dropped even more. Individuals are not in a position to have that type of disposable wealth that they had before that they wanted to do some good with. So nonprofits are cutting and slashing their own budgets and their own workforce, and they're struggling to figure out what they're going to do. And they are looking potentially to see if they can, I don't know if merger really is the right word, but partner and figure out some philanthropic advisory system that enables them to leverage each other's background and networks. So it'll be interesting. If it's a nonprofit school, if we're talking about nonprofit education, we're seeing a lot of potential action trying to figure out there whether or not they're going to be, for-profit, stay nonprofit, merge, bit of a amalgamation. So, and what was that? There was another one? I apologize.
Higher education, healthcare, and
healthcare.
nonprofit.
Healthcare is crazy right now. I mean, and a lot of it's a land grab. You are seeing hospital systems acquire insurance companies. You're seeing insurance companies acquiring generic pharma, and you're seeing generic pharma and branded pharma acquiring telemedicine. It is healthcare. It's the Wild West right now. And I think some of it is a push to get ahead of the curve for what we're seeing with universal healthcare potentially, Medicare, Medicaid being a broken system in many respects, price of pharmaceuticals going through the roof. So that in and of itself could be a 4-day symposium in which you would have everybody's conversation.
I'm going to move on to another question, which is how are parties dealing with the PPP, the loans that came out under the CARES Act, and similar loans in connection with deals and networking capital, purchase price adjustments, and things like that. Let me talk a little bit about that, and then George, I'll throw it to you. The PPP is not a universal good. We could talk about whether or not the PPP was a good idea in the first place, but it became a significant complicating factor for sellers that are clients of ours that were looking to sell. There's a couple of scenarios. One is a company that was going to fail prior to the COVID situation that got a PPP loan that is now surviving on the oxygen provided by that, but is probably still going to fail. Well, that company is probably not going to get bought. So it's not going to be an M&A situation. Then there are companies that were actually doing okay and got up some PPP money, and it became a fight between the buyer and the seller as to who was going to get the benefit of the PPP loan, because it really wasn't going to the employees. The employees weren't going to lose their jobs in the first place or go on furlough or whatever it was. So in some cases, I've had sellers simply hand back the money, saying, I don't know what the audit restrictions are going to be. I don't know how they're going to continue to change the rules. I don't want to have this possibility hanging out there. I want to give the money back. In other situations, the buyer and seller basically negotiated. The buyer was saying, well, wait a minute, I'm now taking your company. Usually it's a cash-free, debt-free transaction, but I'm going to be taking the debt associated with the PPP loan. That's got to in some way be a price adjustment. And the seller turns around and says, what do you mean price adjustment? This is going to be written off in a year from now and to essentially be a tax-free grant. And the buyer says, well, that's what the rules are Tuesday, but we don't know what the rules are going to be on Thursday. So how are we going to handle that? We actually dealt with it with an escrow account to basically cover that, and did have to take it into account for purposes of networking capital and, how do you deal with a cash-free, debt-free transaction when in fact there's debt that's hanging out there. So the PPP is definitely a complicating factor. The ones that are grants are less so, but you do have to be concerned about whether or not there's any lingering liability from having taken that money from the government. George, what's been your experience?
Treat it as debt at closing and make them pay it off.
Really? Even though it's
all 5 deals that we've done since COVID started, treated as debt, paid off at closing. We're not, one, you hit it on the head. Nobody has any real idea how many times it's going to change. 2, we actually had a situation in 2 of the deals where there was still cash left over when the closing was going to happen. They're like, no, pay it all back. We do not want to suddenly find ourselves in a situation in which you didn't use it correctly. We now have a change of control event. Nobody really knows what the Fed's going to say about that. Pay it back. A couple of them used it in the first, we have one right now where we're headed closing where they used it in the first bucket, by that first 8 weeks or 6 weeks or whatever the hell it was. It was all gone. And they gave the seller a choice. You are going to give a personal guarantee to us as to what it was used for, how it was used for, and honestly, it was like $480,000. And the transaction was a $23 million transaction. Mm-hmm. Seller looked at it and said, okay, personal guarantee hanging out there. I got to hang around the hoop until this thing gets done. Blah, 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 the full gambit of stuff. He's like, hell with it. Just take it off the top. I'm just not dealing with it. So we're seeing buyers look at the situation to see if there's anything left. If there's still PPP money left on the books, they're saying, give it back. Give it back now. Give that back now. That's the first thing they're saying. Second thing is they're really starting to dive in whether or not they've got the backup data as to whether or not it was properly done. If you're using an ADP or using any of these payment systems, they actually have it built into their program, the ability to hit a button and know what it was spent on. So, but every one of them right now that we've done, treat it as debt. We're done with it. We're not dealing with it. You don't want to deal with it. Give yourself a break. You know, it's free money. Yeah, it's free money. But from a tax standpoint, right now, the Internal Revenue Service is saying anything you used it for, you can't have a deduction. You give the money back, use the deduction. It's actually not going to be too far off, guys, where you need to be. If you used it for what it was supposed to be used for, and you gave the money back, you're actually, if you run the tax analysis, you're actually pretty damn close to, you know, where you would have been in the end. So we're seeing a push to say, bag it, it's on you, we're not dealing with it. Thank you very much.
Interesting. Jennifer, we've got a few more minutes.
We've got one more question that we can probably answer and then wrap up. Are you able to comment on the impact on cross-border M&A?
Oh.
Are American citizens allowed to leave America at this point? Truth is, I'm seeing very little in the way of cross-border. You know, without going into politics or anything like that, it feels as though we are dealing with a 48-state kind of world right now, and where I've seen a lot of things done before with Canada and Mexico particularly, and certainly Europe. I've got to tell you, in the last 3 months or so, I've been seeing virtually nothing that is international. George,
same thing. As a matter of fact, right now, client has got a major contract with a facility, with a company that has facilities in Michigan and in Canada, and it's actually causing the deal to stall. Because they can't deal with Canada, and they can't get into Canada, and they can't see what's going on. And, electronically they can do everything they want, but there's some concerns with regard to what was being produced in Canada that was being shipped to the US, which now cannot be shipped to the US, it's stuck in Canada. So we're like you, we're seeing, I'm sure there's still mega deals being done, but screeching halt comes to mind. Maybe we haven't gone to, maybe we're at a rolling stop, but it's a real slow roll.
Well, let me just say a couple of small things, which is, we're coming to the end of our time. What I'm hearing, George, I'd love to get your thought, is that there is definitely uncertainty out there. Things are different now than they were 6 months ago, and I can pretty much assume that they're going to be different in 6 months from now. Having said that, solid deals, a selling company that has all the attributes that you'd want it to have, can go to market, close a transaction, and there are buyers with cash ready to go. So the M&A market is not closed. I think deals with hair on them, complicating factors, even things that weren't complicating 6 months ago, like having facilities in Canada, are now a complicating factor that have to be taken into account. So this is very much a time where I think that if you're a seller or a buyer and want to be moving forward, you can, but I think that you really do need some really good expert advice of people who are in the market on a daily basis, because you can't assume that what worked a year or two ago is necessarily going to work in this market. George, would you like to make any closing comments?
Sure, yeah, I would agree with everything. I think flexibility, again, is paramount to getting any transaction done. I think preparedness is extraordinarily important, and you touched on it with, you need good advisors around you. You need a good investment banker, you need a good lawyer, a good accountant. You need to prepare for going to market more than ever now. And that's not just, I'll upload everything into a data room. No, it's time to take a breath, do an analysis yourself. Frankly, do your own Q of A. Get yourself prepared for the long haul. Listen to your advisors. Make sure your advisors feel comfortable working with each other. because the preparedness that you need to be at, the level of that you need to be at prior to going out for a transaction to be bought or go by, you need to spend the time doing the groundwork and cleaning up your house, putting the good clothes on and dressing things up and locking that closet with the skeletons. Because if there's hair, you hit it on the head. Hair equals road bump. You don't want it to suddenly become a stop sign. And I think it's really important to take the time, listen to your advisors, and realize that this is not a 45-day. This is not 60 days. It's not 120 days endeavor. There's a period of time of getting yourself properly set up, working with Sharon, working with George. So that way, then you can go out, and then that 45 to 120 days process starts.
Jennifer?
Yep. Thank you both. What a great discussion. We hope everyone enjoyed this format today. And if you have any additional questions, please feel free to reach out to George or Sharon. You can refer to the attachment that you were sent prior to the webinar, where you'll find all their contact information. And we thank you for joining us, and have a wonderful day.
Thank you.
Thank you very much.